In this video clip, I look at how the sale of a non-current asset between the subsidiary and the parent company and the subsequent reversal of that transaction on consolidation affects your NCI adjustment or calculation. Now, I'm still using question 1811 from the TUTE questions, and there we were told that in the current year, a piece of plant was sold by Wombat to Platypus for $2,000. So from a group perspective, this sale of the non-current asset never occurred. Therefore, we have to adjust the value of the plant downwards to the original cost of the plant or carrying amount of the plant prior to the sale. And we have to reverse the profit that is recorded in the accounting records of the selling company. So in the plant carrying value in the accounting records, an amount of $800 is included, which relates to the unrealized profit on this piece of plant, and we reverse that unrealized profit by adjusting the value of the plant down against the profit recorded in the accounting records of the selling company. That we do by reversing the proceeds on the sale against as well the carrying amount of the plant sold that was written down. Because we adjust the carrying amount of an asset downwards, we create a deferred tax asset reflecting the future tax benefits, and as we adjust for the profit that was recorded in the accounting records, as we reverse that profit, we have to make on a group level the adjustment for the tax on that transaction. So the reversal of the profit leads to a reversal of the tax expense. Now that's all straightforward from our studies on intergroup transactions and how it's dealt with on consolidation. But this question we now further have to consider what's the effect on our NCI calculation. Now let's see from these accounts used in the adjustment to reverse the sale of the non-current asset, which of those accounts affect the equity of the group. Now, the proceeds less the carrying amount of the plant sold gives us the gain on selling the asset. So that is a earnings account. And then the income tax expense, of course, is an expense. So both of these or three accounts form part of the profit and loss of the group. So the effect of that is that our earnings on a group level is going to be reduced, and if there's a reduction in our equity, it means that the NCI has to be reduced proportionally as well. Remember, the NCI moves in line with the movements or changes in equity, so if equity decreases on a group level, the NCI should be adjusted accordingly. So the net effect of these three accounts that are adjusted is a downward adjustment in equity of 560. The NCI owns 25% of the equity, so the adjustment needed for NCI is 25% times the 560. So because of the decrease in equity, we're going to see that we debit the NCI so that our NCI decreases proportionally, and we make that adjustment against the NCI share of profit. Because this is a depreciable asset that has been sold, we also have the knock-on effect that the depreciation, which was calculated on an individual group level, company level, is going to be different from what it should be on a group level, because the plant is carried at two different values. So the depreciation adjustment that has to be made in terms of the intergroup transaction, and these entries of course are passed on group level only when we prepare the consolidated financials, is to reduce our depreciation expense. The reason being that the value, the carrying amount of the plant is going to be higher in the company than what it is for the group. So therefore, when we calculate the depreciation in a company, the depreciation expense are going to be higher than what it should be on a group level. So for this question, our depreciation had to be reduced by 10%. We make that adjustment against our accumulated depreciation, which is the contra account for the asset. By adjusting the accumulated depreciation figure, we change the carrying amount of that asset. So therefore, we reverse the deferred tax asset that we created previously in line with the depreciation adjustment. And as we adjust the depreciation expense in the income statement, so we also have to reverse the income tax expense. So that's the normal entries for dealing with an intergroup sale of machinery or plant on consolidation. Now, the only further consideration is if we don't own 100% of the subsidiary, then any adjustment that we pass on consolidation that affects the group equity, and these adjustments will do because it increases our earnings figure on a group level. So it increases our earnings, effectively it increases the equity of the group. So therefore you know by now that if the equity on group level increases, so the NCI has to increase as well proportionally. So the net effect of this is $7, and 25% of that does not belong to the parent company, but should be extracted from the profit and disclosed separately as part of the NCI.